Greetings and thank you for joining me on the Victory Independence channel. I just want to talk to you guys about what's going on right now as I make this video. The market gaps down, it's down all day, and then my goodness, I need to start taking screenshots of this stuff every week. Every time the market's down, it's down significantly, there's a sell-off, there's a bearish mood on the street, and what do you know? The last hour, the market starts to rally. Sometimes it's down as low as 200 points, and then it closes like down 60 or 50 or up a few points or break even. And today's no different. It was down big, and then of course I don't know what it's going to close at because the video won't be done by the time the market's closed. But here it is rallying again. The jobs numbers came out, so the market's down, and people, the news media outlets are saying it's down because of the jobs numbers. No, it's not down because of the jobs numbers. Okay, if the headline number was 80,000 jobs and the expectation was 100 or 120. No matter what it is, 80 or 100 or 120, if it's that low, even officially, if it's that low, as we all know these numbers are complete BS, if it's that low, that is statistically nothing. It is statistically meaningless in a nation of 300 million people. So, when you look at even the BLS's data, you got a record high of people not in the labor force that continues to grow. That is why you're continuing they're able to keep this unemployment rate steady at around 8%. But the fact is the unemployment picture is not good. You've got officially at least 8 million people, 8.2 million people part-time for economic reasons. That means they want a full-time job. But getting back to why the market was down, it's not down because of the jobs report, 80,000 or 120,000 or missed expectations. It's down because the jobs numbers weren't bad enough to have QE. The market might have gapped down if we would have had 120,000 jobs and met expectations right online, because then it would have been even less likely they would have gotten imminent QE. So be clear on that. The market is down today because the jobs numbers weren't bad enough to where Bernanke's got to come out and all of a sudden start talking and start sending out rumors that more QE is coming, more printing is coming. That's why the market's down, pure and simple. I think there's a significant risk in July for the market being down even more, for a huge correction to happen because of this, basically this battle between the Fed of basically pretending that they're not going to have more QE. You read all of Bernanke's writings in the past, hear his statements. He always said the other Federal Reserves and the other governments didn't do enough when his analysis is being applied to, Japan's recession or the U.S. depression or whatever, the 1970s. It's always they didn't do enough. So, don't doubt this guy. I mean, don't bet against the Fed. I made a video a few weeks ago. I think a crash is significant risk here. A lot of people are hesitant because it's an election year, but with earnings coming out and the Fed not providing that QE, I mean, it's an events-driven market. So if there was a Lehman Brothers moment or some type of major event, you could have markets go down. If there's a major event in the Middle East with oil going up, you could have the markets go up. So it really is an event-driven market, especially this summer and going into the election. I wanted to make a quick comment on gold and silver. Gold and silver, I do see them going down more. Technically, the charts are pretty ugly. So what that means is because there's so much paper gold, and I'm talking about the COMEX, where it's been admitted that there's for every 100 ounces of silver, there's only one physical ounce. So there's so much supply out there that really isn't supply. And it's all liquid, and it's all being traded with computers, and a lot of people have, set trades. If silver goes below 26, they're automatically going to trade. It's not an emotional trade. It's just a trigger that's going to happen. So I think it could be severe if silver goes below 26, and I actually kind of do feel that silver is going to go below 26 because I don't see any catalysts until late August. So I really see the risk of silver and gold going down in July. I see it being less and less as we get closer to August and the Federal Reserve, because I do think QE is going to come in August. I find it hard to believe that they would wait till after the election. It is possible, but I really do think the high risk is July. I have some puts to protect myself on SLV, but it's rather small compared to actually what I own in physical silver and mining shares. So, but it is a risk. Oh, real quick, back to my original point. Sorry, is silver and gold a bubble? I don't think they are, and I think people who ask that question aren't looking at the big picture, because when they try to compare silver and gold to the 1970s, or they look at like the tech bubble or the real estate bubble, you have to consider that central banks, the people who are in charge of creating fiat currency, money, the medium of exchange for the whole world, they're buyers of gold. They're net buyers of gold, and it's been that way since roughly 2009. And if you look at sovereign governments or sovereign wealth funds, that are basically an extension of what the government's doing with their cash, excess reserves, they are buyers of gold. So, so what? The people in the West aren't buying it. The banks in the West aren't buying it. Maybe they're selling it. But if you look at the countries that are producing, the up and coming countries, the BRIC nations, those countries are concerned about the fiat currencies, and they do want to own more gold. So when people talk about it being a bubble, look, I mean, what bubble? We're sovereign wealth funds, and I guess those aren't a good example, but more so central bankers. Were central bankers buying tech stocks? Were central bankers buying real estate? No, but they're buying gold. And of course, people love to say how gold's this useless piece of metal. Well, it's not useless. It's money. It's a medium of exchange. It's something that we can use to trade, and you can use it as a medium of exchange so you can trade it later for something else, and it still has value. So it's not an obsession that it's shiny and looks pretty. Gold, I mean, put some in your palm and look down at it. I guarantee you, you'll want to buy more. It's just in us. So, anyway, is it a bubble? I just don't see it. I see a correction happening. Yeah, sure. Silver went from 21 to $9. Back in 2008. I don't see that happening this time as far as us going from 26 to 9 or something. Could we go to 1750? Sure, it's definitely possible. The problem when we get that low, though, is the physical supply. So, and the miners, are the miners going to be profitable? Especially the newer ones that are, they're 43101s, and their drilling results are based on, $25 silver price or a $30 silver price. So are they going to be profitable? I don't think so. So there might be a lot of new silver that might not come online, or some silver miners like Endeavor Silver. I think First Majestic might have done it, but I know for sure Endeavor. A few months ago when silver went down, the guys at Endeavor said, we're not selling it. We're going to wait it out. And of course, it went to 26. They waited it out and ended up selling the silver for over 30. So it'll be interesting to see what happens. But gold and silver, I don't think they're even close into a bubble. In fact, if you look at the fundamentals of the economy, as you see tax revenues drop and entitlements soar, I think you're just going to have more and more of a debt crisis coming. So, I mean, even if the deflationists are right in that most things go down, because it'll collapse tax revenues, your deficits will skyrocket. You'll have trillions and trillions of dollars of annual deficits. So, in my mind, even if the deflationists are right in the short term, they're just going to be wrong in the long term, because ultimately you have a situation with your currency and you have a situation with your accumulation of sovereign debt. But anyway, that was my quick 1-minute update in under 9 minutes. Later.